Have you ever wondered? If the U.S. Federal Reserve can just print money, then who exactly do they owe it to? It sounds simple, just print it. But beneath that idea lies one of the most misunderstood systems in economics. In this video, we're diving deep into what actually happens when the Fed prints money, who gets it, who owes it, and why every single dollar comes with an invisible promise attached. Let's break it down step by step from how money is really created to why the Fed can't just print endlessly without consequences. First, the biggest misconception. When we say the Fed prints money, we don't mean truckloads of paper cash rolling out of printing presses. In today's economy, money creation is mostly digital. Here's how it works. The Federal Reserve doesn't literally print paper notes. That's the Treasury's job. What the Fed does is expand the money supply electronically by crediting the reserve accounts of commercial banks. Imagine the Fed clicks a button and suddenly the balances of big banks, like JP Morgan or Wells Fargo, increase by billions of dollars. That new money wasn't transferred from anywhere it was created. In exchange, the Fed usually buys something, typically government bonds, also called U.S. Treasuries. This process is called open market operations. So the Fed prints digital dollars to buy assets. The sellers, often banks, receive reserves they can then use to lend, invest, or pay others. Every time that happens, the total money in the economy expands. But here's the key. Whenever the Fed creates money, it's not free. It comes with a liability on its balance sheet. That means the Fed owes someone. But who exactly? Let's go deeper. The U.S. monetary system is built on two key players, the U.S. Treasury and the Federal Reserve. The Treasury is the government's wallet. The Fed is the nation's banker. When the government spends more than it earns through taxes, it runs a deficit. To cover that deficit, the Treasury issues bonds, basically IOUs that say we'll pay you back with interest. These bonds are bought by investors, banks, pension funds, foreign governments, and yes, the Federal Reserve. When the Fed buys these bonds, it doesn't pay with cash it already had. It creates new money, digital reserves, out of thin air to pay for them. On the Fed's balance sheet, those bonds are assets, things it owns. The new reserves it created are liabilities, money it owes to the banking system. So when the Fed prints money, it increases its liabilities to banks while holding the government's debt as assets. Now the Treasury owes the Fed interest on those bonds. And here's where it gets interesting. The Fed returns most of its profits, including that interest, back to the Treasury every year. In simple terms, the government owes the Fed owes the banks, and through taxes and inflation, we, the public, sit at the end of that chain. So, who does the Fed owe money to? The Fed's biggest liability is the money it creates, bank reserves and Federal Reserve notes, the paper dollars in your pocket. Those reserves belong to the commercial banks. So technically, the Fed owes the banks the amount of reserves it created. But remember, those reserves are backed by assets, mostly government bonds, which means the Fed has something of value in return. Now, who owes the Fed? That's the U.S. government. The Treasury must pay interest and eventually repay those bonds. Who owes the Treasury? That's us, the taxpayers. Because government debt is financed by future tax revenue. And here's the twist. Since the Fed gives most of its earnings back to the Treasury, the government is kind of owing itself. It's like moving money from one pocket to another. Except both pockets belong to Uncle Sam. But that doesn't mean debt disappears. Because a big part of U.S. debt isn't held by the Fed. It's held by others. Domestic investors, pension funds, insurance companies, and foreign countries like Japan and China. Those investors must be paid interest. That's real money leaving the Treasury every year. Let's clear up some of the biggest myths people believe about money printing. Myth number 1. If we print money, we don't owe anyone. Wrong. Every dollar the Fed creates is a liability backed by debt or assets. The system is built on credit, not free giveaways. Myth number 2. The Fed can print endlessly without consequences. Again, wrong. Printing money without real economic output causes inflation. Think of it this way. If you double the money supply, but goods stay the same, prices double. That's what happened in places like Zimbabwe and Weimar Germany. Myth number 3. The government can just print to pay off its debt. In theory, yes. But doing that would destroy trust in the dollar. Investors would flee, inflation would skyrocket, and the U.S. currency's global value would collapse. Money only works because people believe it holds value. Break that belief, and no amount of printing can fix it. Let's zoom out to see who really owns America's debt. As of now, roughly 2/3 of U.S. debt is held by the public. That includes individuals, corporations, banks, and foreign investors. The rest, around 1/3, is intergovernmental, meaning the government owes money to itself, like Social Security or federal trust funds. The Federal Reserve is one of the biggest holders of U.S. treasuries. That's why when the Fed creates money to buy bonds, people say it's monetizing the debt. But here's the nuance. When the Fed holds government debt, the interest payments it earns mostly go back to the Treasury. So it's not quite the same as owing a foreign investor. However, when the debt is held by Japan, China, or a private investor, those interest payments leave the country. They're real costs to the U.S. taxpayer. So while some of the government's debt is circular, it owes itself, a large portion represents genuine obligations to the rest of the world. People often ask, if we can print dollars, why not just pay off the national debt? Well, technically the U.S. could, but here's what would happen. If the Fed printed trillions of dollars to pay off bondholders, the sudden flood of money would crush confidence in the dollar. Investors would dump U.S. assets. Inflation would explode, and the cost of everything from food to fuel would soar. In economics, there's no such thing as a free lunch. You can't print your way to prosperity, because printing doesn't create real value. It just changes the numbers in the system. The value of money depends on trust. Break that trust, and the currency itself breaks. That's why even though the U.S. controls its own currency, it can't simply erase debt through printing. The Fed's job is to maintain stability, not to hand out unlimited money. Let's visualize the Fed's balance sheet to really see what's happening. Assets, U.S. Treasury bonds, mortgage-backed securities, loans and other assets, liabilities, bank reserves, Federal Reserve notes, cash, deposits from the Treasury, and others. Every dollar the Fed creates shows up as both an asset and a liability. If the Fed prints money to buy bonds, it owes that money to banks, while holding the bonds as assets. So technically, yes, the Fed owes the money it created, but it owes it to the banking system and the public who hold those dollars. And remember, since the Fed's profits go back to the Treasury, the system is designed to recycle value, not create unpayable debt. Another layer to this story is international. Foreign governments and investors hold trillions of dollars in U.S. treasuries because they trust the dollar. It's the world's reserve currency. This gives the U.S. unique power. It can borrow in its own currency, something most countries can't do safely. But it also creates responsibility. If the Fed printed too much, global trust in the dollar could fall. That would make imports more expensive, interest rates higher, and the world economy less stable. So while the Fed can technically create money without limit, the real limit is confidence, both at home and abroad. Money printing isn't evil, it's a tool. When used carefully, it keeps the economy running during crises, like in 2008 or during the pandemic. But when overused, it can silently tax savers through inflation. Prices rise, but wages often lag behind. So who pays the price for money printing? Not directly through a bill, but through lost purchasing power. Inflation is like a hidden tax. When the money supply expands faster than production, the real value of each dollar drops. So even if no one sends the Fed an invoice, we all pay in the form of higher prices and weaker savings. That's the invisible debt of money creation. So let's answer the question once and for all. If the Fed prints money, who do they owe it to? They owe it to the banks whose reserves they created. They owe it to the public who holds U.S. dollars as a claim on goods, services, and trust. And indirectly, they owe it to the world, whose confidence keeps the dollar valuable. The U.S. government, in turn, owes money to the holders of its debt, including the Fed, foreign governments, and American citizens. In short, the Fed owes the system, the government owes the bondholders, and the people owe each other through taxes, inflation, and faith in the currency. That's the circle of modern money. So the next time someone says, "Why not just print more money?" you'll know the truth. Because every printed dollar is borrowed trust, and trust, once lost, is the hardest debt to repay. If you enjoyed this breakdown, hit that like button, subscribe for more deep economic analysis, and comment below what topic you'd like me to explore next. Thanks for watching, and remember, money isn't just numbers. It's a promise.